So you're thinking of moving to Salt Lake City, Utah. In this video, we're not going to show you around Salt Lake City, Utah so much. We're going to show you around the ropes of getting qualified for one of the 10 loan programs for first-time home buyers. If you stick around until the end, I'm going to share with you the best kept secret about getting qualified for a loan that I think a lot of people don't know about, that's definitely going to help you in the process if you want to move into your first home in Salt Lake City, Utah. We're gonna get after it right now. If this is your first time on our channel and you want to know everything there is to know about living in Salt Lake City, Utah, then subscribe below and tap the bell for notifications so you can be the first to know about all of the market fluctuations and the current market in Salt Lake City, Utah. My name is Ryan Shupit with Homes in Salt Lake City. We get calls every single day from people just like you. So whether you're moving in 9 days or in 9 months, feel free to reach out. All of our contact information is in the box below here. We would be happy to help you make a smooth move to Salt Lake City, Utah. Now let's take a closer look at some of the loan programs to help you get into your first home in Salt Lake City, Utah. The first loan program I want to talk about is the FHA loan program. I just sold a property for my clients. My clients were the sellers and the buyers used an FHA loan. And this was actually their second home that they were buying. They have another home in Texas and they were buying this home in Utah because they wanted to be near their daughter who was having their first grandchild. They wanted to be near the grandchild. And so they used an FHA loan. And the reason they decided to use that FHA loan is that the rates for the FHA loan tend to be a little bit lower than they are for conventional loans. Now, there are different requirements than a conventional loan, but that lower rate saved them $6,000 a year in mortgage payments. So that sounds worth it to me. So what are the qualifications for an FHA loan? So the first one is going to be, it's a low down payment requirement. You can have as little as 3.5% down to use the FHA loan, which for a lot of people, that is relief. A lot of people think you need 20% to get into a home. Just not true. You can have a variety of credit scores. The credit score requirement is a little bit flexible for FHA, and it can be used for a variety of property types. So single family or condo or multifamily property. The one thing about the FHA loan that is a little bit of a mark against it, you're gonna have that mortgage insurance premium required. It's just part of the FHA loan. You've got maximum loan amounts that vary by county, obviously. So that's gonna be another thing to check in with is, will this FHA loan cover the amount that you need loaned for the property that you want? So that's a consideration. Usually they kind of go by median, so that unless you're buying something way above the median, it shouldn't be much of a problem, but definitely keep that in mind. The second loan that I want to talk about is a VA loan. Now, one thing I've noticed doing real estate in the last 5 years here is that for some reason, a lot of people are a little bit hesitant about taking a VA loan or an FHA loan. There's two reasons. The first reason is that when you get an appraisal for either of these loans, whatever that appraisal comes in at for the home, it's now attached to the property for 6 months, I believe. It might even be 9 months at this point. But it's basically attached to the property for a long time. So if that buyer, so sometimes when the appraisal comes in low, the seller says, well, I'm not lowering my price. I'm gonna make you either pay it or drop out of the contract because I think I can still get this price from someone else who's willing to pay it. But if you have that appraisal attached to the property and the next person who comes along is also a VA or an FHA loan, they have to use that same appraisal. So you can't get around that to get more money from an FHA or a VA buyer. So sometimes people are a little bit wary about that. But if you're selling a property that's newer, it shouldn't be an issue. I have not had a lot of problems getting FHA or VA loan applications accepted. It's definitely one of the things that's going to be important about your real estate advocate. So the other thing about these two loan types that people don't like is that there's going to be there's basically like a quality check, I guess you could say, and it's an appraisal sort of for the VA and FHA loan, where someone comes and makes sure that the railings are there and that the paint isn't peeling off the house and the roof still has some life to it, those kinds of things, just to make sure that you're not buying a house that's going to immediately need a bunch of work to bring it up to livability. And so sometimes people are a little bit wary about that because you just never know what the appraiser is going to say needs to be done on the house. So that can be a little bit of a challenge to keep in mind too. So let's talk about what the qualifications for a VA loan are. The first one's going to be, it's basically, this is probably pretty obvious for a veterans administration loan. It's open to people who've engaged in military service. You've got military service members, veterans, and surviving spouses. Those are the only people that are going to be using VA loans. You don't even have to have a down payment at all if you are able to use a VA loan. There's no private mortgage insurance required, which is a pretty great thing. This is a huge benefit of being a veteran. You've got competitive interest rates, much like the FHA, and the funding, but there might be a funding fee that's required for you to use that. But due to all the money that you're going to save on the back end, I would say the funding fee is probably not going to be the biggest thing you're concerned about. So that's number two. The third one is going to be USDA loan. Now, a USDA loan is a really fantastic program if you live a little bit on the ex-urban side of things, if you're not living downtown in a city, that kind of thing. It's designed for properties in eligible rural and suburban areas. Now, I think you used to be able to get USDA loans over in Eagle Mountain. I'm not sure if that's still true, if there might be too many people to get a USDA loan now, but as recently as 2, 3, 4 years ago, you could definitely use a USDA loan out there. So keep that in mind. Some of these outskirts, Saratoga Springs, places like that, you don't need a down payment to use an USDA loan, so that makes it pretty great. So I think the idea is that there are lots of programs for people who live in cities, and they're trying to create a program for people who don't live in cities, right? So you've got flexible credit score requirements there, and some income limits might apply. You might be able to make too much money to apply for this USDA loan, but usually I find that the limits are pretty reasonable, so I wouldn't worry too much about that. You have an upfront guarantee fee and an annual fee required, so keep that in mind. The fourth type of loan program is going to be a conventional 97 loan. That basically means that you have to have 3% down. A 3% down payment, meaning that 97% is financed, right? So 3% down, you're gonna have private mortgage insurance if you have less than 20% down. But once that 20% equity is in place after you've been paying down for a number of years, or maybe what happens is you pay down for a while and the property appreciates in value and you get another appraisal and it shows that you have 20% equity in place, that mortgage insurance drops right off. That is not going to be the case for FHA any longer. It used to be that it would drop off when you reach 20%, but they changed the rules so that it doesn't drop off. And I suppose you could refinance into a conventional to get the PMI off if you really wanted to, but something to keep in mind. You're going to have a competitive interest rate for a conventional loan. They're going to be really decent rates, and you're going to have flexible credit score requirements too. These loans are intended to be for the majority of people who want to buy a home. So it can be used for your primary residence, and it can be used for other residences too, but it's going to have different requirements. So that's something to keep in mind too. Okay, number 5, the fifth loan that we're going to talk about is the Good Neighbor Next Door program. It's available to law enforcement officers, teachers, firefighters, emergency medical technicians, Basically, what they're saying is that these are the kind of people that you want as your neighbors because they're good neighbors, right? So there's going to be a 50% discount on the list price of a home in a revitalization area, which that's huge. That's a tremendous boost up for these people, right? You have to commit to live in the home for at least 36 months, which is 3 years is really not that long, but if your financial situation is changing rapidly, then 36 months might be a long time. I don't know very many people that go from, this earning to this earning in 36 months, but I suppose it does happen sometimes. There's going to be down payment assistance available for some of the people who are using the Good Neighbor program, and they're going to be eligibility restrictions. Obviously, that's going to be different across the board for different people in different situations, different counties, that kind of thing. So something to think about. The sixth loan program. The sixth loan program that we want to talk about is the Home Ready Loan. This is designed for low to moderate income borrowers. It requires a 3% down payment. Basically, unless you're in the military, it's pretty hard to get away without any down payment whatsoever. Although there is an option, stick with me here, but for this program, for the Home Ready Loan program, you're going to have flexible income limits based on an area median income. So like I keep saying, they really do a pretty good job of keeping in mind what the area median income is, and they base the limits on that. So it's going to be different all over the place, which makes it hard to make a video that's going to work for everybody, but I find that it's just helpful to know about the different programs to look into. So there's going to be a homeownership education course that's required for the Home Ready Loan. But the thing that I really like about the Home Ready Loan is that it has reduced mortgage insurance costs. Not that the mortgage insurance is so much, but I think for a lot of people, they're calculating how much they can afford for the loan, and then they don't factor in that mortgage insurance. So, a couple $100 a month can make a huge difference for a lot of people, right? Number 7, the 7th home loan program is Home Possible Loan. Home Possible Loan is designed for low to moderate income borrowers. It also requires a 3% down payment. You can have a pretty wide range of credit scores there, and it can be used for 1 to 4 unit properties. I think that's different from some of these other ones where you basically have to buy either a condo or a single family home. You cannot buy multi-unit properties. Home ownership education course may be required. I find that it tends to be required of my clients when they use it. The 8th program that I really, really love is the energy efficient mortgage. This allows borrowers to finance energy efficient upgrades into their mortgage, which is really cool. I think if you wanted to get some solar or a heat pump, which I am so excited to get a heat pump because a heat pump is super efficient and it's cheaper after you've bought it, of course. But the thing that's lovely about it is that it works to heat your home and to cool your home, same unit, and it does it using, that's too technical. It's just cool. It's really cool and it's very efficient. So the thing about the energy efficient loan is that it can also be used with FHA, VA, or conventional loans, okay? So essentially what you're doing is you're financing these improvements that you're going to do to the home on top of using FHA or VA or conventional loan. So it can increase the borrowing power based on the anticipated energy savings, which is really fantastic, especially in Salt Lake, because in Salt Lake we have a lot of homes that were built in 1910 to 1950, and they tend to be a little bit less energy efficient than a home built in 2020, right? You have a energy assessment is going to be required, obviously. And then number 9 is going to be the 203K, which is a rehabilitation loan. I worked on a 203K with a friend once upon a time. It was a lot of work. And really what it came down to is that what he wanted to do was buy the home and then get it rezoned to make it a multifamily unit more than it already was. And that was the difficult thing with the 203K, lining that up, the requirements of the 203K with the multifamily, getting it rezoned. Like it wasn't certain enough to make that happen. So what is the 203K rehabilitation loan? Well, it's available to borrowers to finance the purchase or refinance of a home, as well as the cost of the renovations in one loan. So you are getting the improvement loan with the loan to buy the home at the same time. And it's available for primary residences, including condos, mixed-use properties, but it also requires that 3.5% down payment for FHA, because basically it's an FHA loan. It's an FHA 203K loan. And it really creates space for a wide array of renovation projects. The wonderful thing about the 203K FHA loan is that there are so many homes out there that need just a little bit of updating to make them really, really great homes. And I think this program helps me help clients to see the potential in a home that's a little bit run down. There are lots of renovation projects available for home buyers in Utah, especially because in Utah we have a lot of homes that were built in 1880 to 1955, and those homes tend to need just a tiny bit of love. So that's kind of a cool thing about the 203K program. Number 10, our 10th program that we're going to talk about. Number 10, magical number 10. I think this is the best kept secret in all of Utah lending, mostly just because it is the Utah Housing Corporation. It's a first-time home loan program. It's designed for first-time home buyers in Utah. What is a first-time home buyer? Generally, that means that you haven't owned a home in 3 years. So if you owned a home in the past, but you haven't owned a home in 3 years since then you are a first-time home buyer. It's a down payment assistance option, potentially, if that's something that you need, but they have competitive interest rates, which is really great, because for first-time home buyers, that's going to be one of the most important things, right? You have income and purchase price limits that apply, but like with other programs, they tend to be based on median of the area, so they tend to have really reasonable numbers, and they're different all over the place, which again makes making a video that applies to everyone difficult. But I would say that if you look at the median price, then it should apply to the home that you want to buy. So just keep this program in mind. There's going to be a home buyer education course required, and the wonderful thing about the Utah Housing Corporation is that there's additional down payment assistance available if that's something that you needed. So the way that works, and this is kind of why I was harping on the competitive interest rate, is that if you need down payment assistance, you're getting your loan for the home itself, and that has a competitive interest rate, but then you're also getting a second loan for that down payment assistance. You get the second loan for the down payment, and that interest rate is going to be a little bit higher than it would be for your regular home loan. I think it's because it's a little bit riskier for lenders, and so they just need a little bit more. Basically, they charge you more because it's riskier. So that is the tiny little nugget about Utah loan programs that I think everyone should know about, that most people don't know about. They think you need 20% down. You can have as little as 3% down, or even 0% down with the Utah Housing Corporation. The difficult thing there is that you will be financing more than 100% of the cost of your home, because those two loans have higher interest, and that tends to put it towards like 103% loan to value on the home. And it hurts to be underwater on a home just starting out when you own the home for the first few years. But if there's no other possible option for you, maybe this is just the right thing for you.